While investing can help you accumulate wealth, it's important to weigh the risks and potential rewards. And you'll want to be in a position to do that financially, which means you'll need manageable debt levels, a sizable emergency fund, and the ability to ride out market ups and downs without having to use your money. Today we are going to talk about top 10 best investments right now. Before starting, make sure to like and subscribe to our YouTube channel for more future videos. Number 10. Rental housing. If you're willing to handle your own property management, investing in rental housing can be a great decision. You'll need to choose the appropriate property, finance it or buy it outright, maintain it, and deal with tenants if you choose to go down this path. If you make wise purchases, you can succeed greatly. For long-term investors who want to manage their own properties and produce consistent cash flow, rental housing is a good investment. You won't have the convenience of using your internet-enabled device to buy and sell your assets in the stock market with a simple click or tap. Number 9. NASDAQ 100 Index Funds. Investors who want exposure to some of the biggest and best tech companies without having to pick winners and losers or analyze specific companies should consider an index fund based on the NASDAQ 100. The fund's 100 largest NASDAQ companies are among the most prosperous and reliable businesses. These businesses include Apple and Alphabet, each of which contributes significantly to the overall index. Another well-known member company is Microsoft. A good option for stock investors seeking growth who are prepared to put up with significant volatility is a NASDAQ 100 index fund. Investors must be prepared to make a long-term commitment of at least 3 to 5 years. When investing in an index fund that is trading at all-time highs, using dollar-cost averaging as opposed to a lump sum can help lower your risk. Number 8. Value stock funds. Value stocks, which are more affordably priced than other market securities, are the focus of these funds' investments. When stock prices rise, as they occasionally do, many investors wonder where they should put their money. Value stock mutual funds might be a wise choice. Value stock funds are a good choice for investors who don't mind the volatility that comes with stock investing. To weather any market hiccups, stock fund investors must have a longer-term investment horizon of at least 3 to 5 years. Due to their low cost, value stock funds will typically be safer than other stock fund types. However, because they are still made up of stocks, they will fluctuate much more than safer investments like short-term bonds. Government insurance does not exist for value stock funds either. As interest rates increase and growth stocks lose relative appeal, stocks typically perform better. For many investors, another draw is the fact that many value stock funds also pay dividends. Number 7. Dividend stock funds. Dividends are profits that can be distributed to shareholders, typically once every 3 months. Individual stock purchases, dividend paying or not, are better suited for experienced and intermediate investors. However, you can lower your risk by purchasing a number of them in a stock fund. For almost any type of stock investor, dividend stock funds are a good option, but those seeking income may prefer them. These may be appealing to investors who require income and have longer investment horizons. Dividend stocks carry risk, just like all stock investments. Although they are regarded as being safer than growth stocks or other non-dividend stocks, you should take care when selecting them for your portfolio. Number 6. S&P 500 Index Funds. Approximately 500 of the largest American companies make up the fund, which includes many of the most prosperous global businesses. For instance, 2 of the most well-known members of the index are Amazon and Berkshire Hathaway. An S&P 500 index fund is a good alternative if you want to achieve higher returns than more conventional banking products or bonds, though it does have more volatility. For novice investors, an S&P 500 index fund is a great option because it offers extensive, diversified exposure to the stock market. Any stock investor looking for a diversified investment who can commit to holding their investment for at least 3 to 5 years should consider an S&P 500 index fund. Due to its composition of the best companies on the market and extensive diversification, an S&P 500 fund is one of the less risky ways to invest in stocks. It still contains stocks, so it will inevitably be more erratic than bonds or any other bank products. Number 5. Short-term corporate bond funds. Bonds, which can be packaged into funds that own bonds issued by potentially hundreds of corporations, can be issued by corporations as a way to raise money from investors on occasion. Since short-term bonds typically have maturities between 1 and 5 years, they are less prone to interest rate changes than intermediate or long-term bonds. For investors seeking cash flow, such as retirees, or who want to lower their overall portfolio risk while still earning a return, corporate bond funds can be a great option. For risk-averse investors looking for a little bit more yield than government bond funds, short-term corporate bond funds can be beneficial. Short-term corporate bond funds are not FDIC insured, just like other bond funds. There is always a chance that businesses will experience a downgrade in their credit rating or experience financial difficulties and make bond defaults. Make sure your fund is comprised of top-notch corporate bonds to lower that risk. Number 4. Series I bonds. Individual investors can purchase savings bonds from the U.S. Treasury, and the Series I bond will become more and more popular in 2022. This bond contributes to the construction of inflation protection. In addition to paying a base interest rate, it also includes an inflation-based component. As a result, the payout increases along with inflation. The interest rate will decrease if inflation does, though, and vice versa. Every 6 months, the inflation adjustment is reset. Series I bonds, like other government-issued debt, are appealing to risk-averse investors who don't want to take any default risks. For investors who want to safeguard their investment against inflation, these bonds are a good choice. Investors may use up to an additional $5,000 of their yearly tax refund to buy Series I bonds, but they may only purchase a total of $10,000 in a single calendar year. Number 3. Short-term government bond funds. Mutual funds or ETFs called government bond funds invest in debt securities issued by the federal government of the United States and its departments. Short-term government bond funds, like short-term CDs, don't expose you to a lot of risk when interest rates rise, as they did in 2022. The funds make investments in mortgage-backed securities and U.S. government debt issued by GSEs. The low-risk investor would do well with these government bond funds. Beginning investors and those seeking cash flow may find these funds to be a good option. Investors who are risk-averse may benefit from government bond funds, though some categories of funds, such as long-term bond funds, may fluctuate significantly more than short-term funds due to changes in the interest rate. Because the bonds are backed by the full faith and credit of the U.S. government, funds that invest in government debt instruments are regarded as among the safest investments. Number 2. Short-term certificates of deposit. Banks issue certificates of deposit, or CDs, which typically have a higher interest rate than savings accounts. And if you anticipate an increase in interest rates, short-term CDs might be a better choice because they allow you to reinvest at a higher rate when the CD matures. Retirement investors who are able to lock their money away for a while and don't require immediate income may find CDs to be a good option because of their safety and higher payouts. Risk-averse investors who need money quickly and are willing to tie up their cash in exchange for a little bit higher yield than they would get from a savings account should consider a certificate of deposit. Number 1. High-yield savings accounts. You get interest on your available funds when you have a high-yield online savings account. High-yield online savings accounts are accessible vehicles for your money, just like a savings account earning pennies at your local bank. For those who will soon need access to money, a savings account is a good option. For investors who are risk-averse and want to minimize the chance that they won't get their money back, a high-yield savings account is a good option. You don't have to be concerned about your deposit being lost because the banks that provide these accounts are FDIC insured. Although high-yield savings accounts are regarded as safe investments, similar to CDs, if rates are too low you run the risk of losing purchasing power over time due to inflation. That's a wrap for today's video. What are your thoughts on our list? Let us know in the comments section below. And make sure to like and subscribe to our YouTube channel for more future videos.